It's official, the Reserve Bank's jacked up interest rates for the fifth time in 5 months by 0.5%.
If they keep going up, it's going to be an absolute disaster out there.
Pushing interest rates to a 7-year high, some economists fear the Reserve Bank's drifting out of touch.
They're flying a bit blind on this one. They don't know, when all the impacts are going to come. The big risk, of course, is that they go too hard and fast.
Fast and furious Governor Phil Lowe lifting rates by 2.25% since the end of the record pandemic low in April. But a lag in banks passing on rate hikes means most borrowers are still stomaching June's jump.
It can take a few months for those impacts to flow through the economy, and for many borrowers it will be 6 or 12 months' time.
For some borrowers, that's already crashed their budgets.
The funny thing is, I'm actually about to be a first home buyer. Now I'm not able to borrow as much as I was normally able to.
We have to spend more on the home loan, insurances, everything. We have to pay more, but our incomes are still the same.
For the average $500,000 loan, today's rise adds an extra $144 to monthly repayments. In total, that's $600 extra since May. Today in Canberra, the rubber hit the road.
Is our country in pain? Free markets save the planet. Housing prices up 500%, cars 800, electricity and health insurance 400. Action when?
Interest rate rises do mean that Australians will have to make more hard decisions.
Last October, the RBA advised Aussies rates would likely hold firm until 2024. But now borrowers are copping whiplash from just how quickly they're rising.
With cutting back on a few things.
It's like survival mode. Everyone's in survival mode right now.
The preconditions that Dr. Lowe set when he said interest rates wouldn't go up until 2024 have not been met. That of itself is enough for us to call on him to go.
And EY Chief Economist Sherelle Murphy joins us now. Sherelle, you wrote today that the RBA is not there to be popular, it's there to steer the economy. These sound like fighting words. What do you mean?
Well, the Reserve Bank is a little bit like the responsible parent at an 18th. When things get a bit out of control, they'll take the beers away, but they don't want to stop the party altogether. I think the thing that's difficult for us is that we haven't had a rate hike since 2010, believe it or not. So I think a lot of us are a bit out of practice. We don't remember what all the roles that the Reserve Bank has. So at the moment, they've really got to sort of slow things down because otherwise the economy will run away, inflation will be strong. And that's really hard on some households, particularly vulnerable people.
Sherelle, you use the responsible parent analogy, but isn't part of being a responsible parent meaning that you can be taken at your word, whereas a lot of borrowers feel misled by the RBA's comments on rates not rising until 2024? So if you borrowed based off the RBA governor, do you have a right to be extremely annoyed?
Yeah, it's a good point. I think there's definitely some borrowers out there, particularly those that have gone into the market quite recently and taken on quite a lot of debt, that would be really feeling the pinch right now, and especially, of course, with interest rates going up pretty quickly, certainly compared to the rate rises that we've seen in the past. So yes, they do have a right.
Sherelle, we have had 5 rate rises in a row now. When will we know if they're working?
Well, I think they already are. You look at house prices, if we were to average that out across the country as a whole, they're down about 4%. That's not a lot, but it certainly does suggest that the market has turned. When you also look at survey measures, there's one out by NAB, for example, that shows that people are starting to replace their normal products with cheaper alternatives at the supermarket. So all these things do suggest that people are starting to change their behaviour, and that's, of course, exactly what higher interest rates are designed to do.
Sherelle, I'm slightly stuck on the idea of an 18th birthday party without any beer.
Doesn't sound like much fun.
Yeah, so is that the reality? Like, this party that we've all been at is kind of over?
Well, I think that is part of the reality. We have had it good for quite a long time. Remember, the cash rate was 0.1%. That's very low. Some people were getting mortgage rates of under 2%. That's not sustainable because we do see the economy running a little bit too hot, and the Reserve Bank is just trying to cool it down a bit. But as I say, it's not trying to end the party and it's not trying to put us into recession. It's just trying to cool things down.
So, Sherelle, is there anything that people can do who bought at the peak of the market to avoid a mortgage debt trap?
For most people, if they have a job, they'll be okay. So they can service a mortgage if they've still got their job. And the other thing is that wages are actually moving up. Now, they're not moving up perhaps as much as we'd like them to, but they are. And the other thing, of course, is that people can shop around. You know, they can look around for a better rate on their mortgage, and we'd absolutely encourage them to do that.
Sherelle, thanks very much for your time tonight.
Pleasure.